Now we're back into the detailed video for Fibonacci, right? So like from the previous video, I explained to you the whole concept about Fibonacci and what we as traders seek to use it for, purposefully measuring possible retracement levels before the market continues in its prior direction, right? So you must understand that when it comes to the concept of Fibonacci, most traders use Fibonacci, and every technical trader has certain percentage value which they believe to be the best retracement point before any continuation in the market. So what it basically means is that most traders are independently opinionated when it comes to percentages they should use in Fibonacci. Some people believe in the 23%, some people believe in the 38%, some people believe in the 50%, some people believe in the 61.8, and then others believe in the 78.6 retracement levels, right? So yes, with all these numbers, if it's new to you what Fibonacci is, it may sound very confusing, but I'm going to go right into the chart and break the whole process of Fibonacci down to the very basic, that is not going to be very clouded in your mind again, right? Now I'm also going to show you specific tips and tricks into plotting Fibonacci perfectly. But before we even go into the Fibonacci settings and all that, what I want you to do is understand the whole concept, right? Like I explained to you in the previous section, I told you guys that we all as traders know that the market doesn't just drop all the way down, like, right? Like as you can see with gold, what can we see? A drop, and then what happens here is a pullback. So this trading in the opposite direction of the market is what we call a pullback. Then what can we see? We can observe a continuation, and then what happens again? A pullback into the opposite direction, and then there again what happens? Another continuation. So overall this market is dropping in that downtrend, but upon every instance we have the market taking a breather, and the breather here means pulling back into the opposite direction before continuing in its prior overall trend, which is a downtrend we can see here, right? So as traders, we want to measure likely pullback level using percentages from the Fibonacci concept to know possibility of the turning points the market can make, or the zone where the market is likely to have a turning point before its continuation. That's the whole purpose of Fibonacci. So like as traders, we are using Fibonacci to measure that, okay, with this market dropping from point A here to point B here and pulling back into point C here, we can use Fibonacci to measure that point C here and now jump in for a sell trade to continue in that sell direction, which is all the way down here to point D, right? And then from point D, we can see that the market also pulled back again. So let's call here point E. We can use Fibonacci to spot on identify this zone for another sell trade to continue this market all the way down like that, right? Now somebody may be confused and say, okay, Kojo, you're saying we're going to use Fibonacci to measure point A to B and then possibly determine point C as a retracement, or measure point C and D and measure possible E as a retracement and continue the trend. But if we're finding E retracement, are we going to start from point A with the Fibonacci and end on point D? I'm going to clarify this right now, right? So now understand the market from when I was telling you about how to understand or how to perceive swing points in the market. Now if you've not really had a good grasp of swing points, Fibonacci is going to be a very difficult concept for you to understand. I told you guys that what in looking at the market too, you want to really ignore minor glitches or minor pullback in a swing point, right? I'm going to denote what I mean by a minor glitch or a minor pullback in a swing point to you. Now most people may have different opinions about that, but as far as you are learning from KOJO Forex good strategy, this is exactly what I want you to do and exactly how I want you to follow it. So yeah, with this kind of a glitch here, you want to ignore it and then see that whole move from the top, very top here, all the way to down here as one swing point. And again, with this glitch that we have here, you want to ignore all this and then see from this very top to this very bottom here again as what? One whole swing point in the market. Once you're able to wrap your head around this, you are 50% ahead of understanding Fibonacci already. Now let's go into the mathematics aspect of it. So let's say we are considering point A to be here of a swing point, and then the market gets all the way down here as point B. So we have the market trending from point A, making its own movement up, down, and then eventually hits point B, right? As traders, we can automatically see, this is from a mathematical perspective, that this point here signifies a mid-range of this whole swing point that I have denoted here or I have drawn, right? What sense can we make out of it? If we want to consider here to be 0 and then here to be 100, then it makes sense for us to see here as 50, which is the midpoint, right? Now remember that Fibonacci, we're using percentages in denoting our level of pullback, right? Now again, I'm emphasizing that see point A and point B as a swing point in the market. Swing point is, this is a swing point, like A here to B here can be like a swing point in the market. So if this is 0, 50, 100, you would definitely agree with me that we can anticipate, or we can sort of, you know, look into this area right here as a 25% division, while we still maintain here as a 50%. You're also going to agree with me that we can go ahead and then divide this area right here as 75% division. This is just mathematical base, right? So we have what, 0, 25, 50, 75, and 100, which is 4 equal divisions of this swing point, right? So as traders, we are basically saying that what the market can pull back, right? Just like from this area, it can just pull back into the opposite direction, like we can see from the real chart, and then continue in its prior movement, right? But the reality is that most people that subscribe to Fibonacci, right, before we even get into how to set up the tool, they don't even know exactly when to start plotting Fibonacci on the chart, right? But this is a very practical example for you to understand exactly where you should start thinking about the market from a Fibonacci perspective. Now see points 0 to 100 as that long swing point, and then we have been able to divide each one of them into 4 equal halves. Once you have been able to determine that we have a long continuous movement in the market, which can be denoted as point A to point B, right? The moment you see the market moving in the opposite direction, at least 25% in the opposite direction, then that is a basis for you to start anticipating that this market is making a pullback into the opposite direction, right? At least. Now if I see anything less than 25%, I don't start putting my mind on the fact that this market is approaching a key Fibonacci number, right? So this is just a first concept for you to understand how I put on my Fibonacci. Now let's go into the very details of the specific Fibonacci numbers that I use. I explained to you that I subscribe to key Fibonacci percentages, and every trader in the market, depending on their belief system, their backtesting system, or the system in which they believe in with respect to their trading style, have specific Fibonacci ratios that they believe in, right? So let's head straight into the specific Fibonacci numbers that I believe in. Now the Fibonacci numbers that I believe in is the 50% retracement, the 61.8%, and the 78.6 retracement values. So what this means is that once we have had a swing point from point A to point B, and then the market is pulling back into the opposite direction, I kind of suspect this market to respect each one of this. It could be any one of them, but it should fall in between the 50, 61.8 and the 78.6 bracket before a continuation in the opposite direction. But before I start putting my Fibonacci on the chart, I've told you guys that I want to see the market move at least 25% in the opposite direction, and then once they approach, let's say, the 50% and I see any reaction wise, I mean candlestick patterns, that tells me that we are likely to continue in the opposite direction. I take my trade, and I take my trade on the basis of the market making a 50% retracement. There are certain times where it can actually break through the 50 and head straight towards the 61.8 and give us a reaction exactly on the 61.8 before a continuation on the downside, right? Certain instances, you also see the market reacting in between the 51.8, reacting in between the 50% and the 61.8 before it makes any continuation on the downside, and after it has given us a consistent reversal pattern, right? The same thing happens with the 61.8 and the 78.6 region. But nonetheless, as traders, we want to really watch in between any of these regions, the 50%, 61.8, 78.6, before we anticipate the market moving in the opposite direction, right? Once you're able to wrap your head around this, then you are already a big step ahead in understanding Fibonacci. Now we're going to go straight into how to set up the Fibonacci, right? In order not to waste time, if you're using TradingView, it's pretty easy to come onto the left side of the chart and then pick up your Fibonacci tool here, right? I've already added as part of my favorite. Now if you come there, in order not to waste time, right, I'm going to open up my Fibonacci and then show you guys the settings that I use for my Fibonacci, right? So in terms of my settings, I want to see my trend in black. I have the 0 level, 61.8 level, the one which signifies 100. Then I have the negative 61.8, which is the Fibonacci extension, and I have the negative 27, which is also an extension. We'll come to extension, and we have the 78.6 and then the 50%, right? So if you come down here, I usually have a slight background in terms of colors for my Fibonacci, as you can see, as denoted here. And I want to show my Fibonacci in value, in percentage values, right? So with the 50%, 61.8, 78, and I want to show them on the right side of the chart. So if you can see clearly from my settings here, then you can exactly plot the same for your Fibonacci, right? Now, before I even continue, let me give you guys a little background of the Fibonacci extensions, right? So understand that we've said that Fibonacci gives us the basis of understanding, you know, a retracement level in the market, right? So as far as retracement is concerned, we're seeing that the market can start from point A, get to point B, and pull back to, let's say, point C here, and point C can be anywhere between the 50, 61.8 and 78.6. Now the market, after it has retraced, comes back to point B, which is down here, right? But if it breaks down here, then it's creating a new low, and upon that creation of a new low, the market can head towards another particular point before another level of retracement can occur, right? Let's say it can come all the way down to hit this value right here, or come all the way down here, any one of this, and then pull back into the opposite direction. But Fibonacci extensions is the one that is going to give you the likely stopping point after it has broken this low here to create a new low, right? So the extension can give you specific values. Now if I put the Fibonacci tool on these lines that I've drawn here, right, starting from point A to point B, right, now you can see that if I zoom this out a little bit, we can see that we have the extensions lying down here, which is the negative 27, and then we have the negative 61.8. So we're saying that the market can come all the way down from point A, point B, retrace into 60, 51.8 or 78.6. But if it breaks that B level, then it can head either to the negative 27 or it can head either to the negative 61.8 region. So it can be a take profit level for us. And in fact, you're going to understand this when I explain Fibonacci on the practical chart, where we're using gold to denote that, right? So extensions is nothing different from the retracement, right? The only difference is that retracement measures the pullback, and then extensions gives us an anticipation for the continuation, right? So retracement will measure this pullback. Extension, after the market has broken this low, we can use extension to find next probable level that the market is heading towards, right? Now I'm going to show you again how to also plot the Fibonacci. because Fibonacci is not also only meant for a bearish market. Fibonacci can both be used for bearish and bullish market. Fibonacci can be used both for bearish and bullish market. So don't restrict your mind based on the fact that every example I am doing here is for a bearish market. The simple trick is that if you have a bearish market, then you want to see the top here as the beginning and then the down here as the end, which is the B, right? Now if we're talking about a bullish market, right, let's say all things being equal, we have a market rally from up here and then made a retracement and continued. You want to see here as A and then that swing point here as B. So you want to start your Fibonacci from the bottom to the top for a bullish market. So for a bullish market, you start from what? The bottom to the top. And then for a bearish market, you start from the top to the bottom. I believe this one clears up that whole confusion about how to plot Fibonacci. We have a lot of people that fairly have the idea into Fibonacci and they get lost about how to even plot it, right? Sometimes they don't even know where to start from, whether it's the bottom to the top or top to the bottom. But if you get the explanation I've just given here, it should be very, very straightforward and clear to you, right? So let's take a few examples of what we have learned on Fibonacci so far. So looking at gold in this bearish market, right, we can see that what, like I've denoted to you, we can identify this swing point from this range all the way down here. So by here we would have had what, that retracement value, right, in terms of the fact that the market would have done at least 25% move in the opposite direction, which convinces us that now we can use Fibonacci to find likely retracement before that bearish continuation. So we pick our Fibonacci 2, we start from the very top and at the very bottom here. Then we can see that what, within this space, which is the 50, 61.8 and 78.6, there's likelihood that the market can pull back into any of these regions, reject, show us certain candlestick patterns and confirmations before a continuation on the downside. And our continuation on the downside, if it breaks this zero area, it is likely heading towards this negative 27 extension, or perhaps even this negative 61.8 extension, right? So with leaving this, let's see practically how this thing plays out on the chart. So it comes into the 61.8 and the 78.6 region as I've denoted to you, right? Let's see some few price actions that happen here: consolidation, rejections, and then the market start to trade and continue its movement onto the downside, right? So we have this market quickly tapping into the 78.6 retracement, like I told you, which can be like a target for this market after it has made a significant retracement from the 61.8 and the 78.6 region. You can see that this market pulled back into 50, 61.8, 78.6, which is like my key Fibonacci levels, right, from the video or from the earlier explanations that I made for you, right? Now that this one has fulfilled its setup, right, you want to now clear up your chart, delete every Fibonacci tool you had there because that setup had already been fulfilled, and now you want to observe this new swing point. And then the new swing point is not going to start from here as A. Let's denote here as A, B, C, and now we have D, right? This new swing point is not going to start from A to D. It's actually going to start from C to D, because that is like the new extension or the new trend that the market has just formed, right? So as far as you are looking at this market and then you observe, you know, a pullback which makes up to at least 25% push in the opposite direction, like you can see here is even approaching the 50%, right? Then you want to already plot your Fibonacci from C to D now, right? You want to plot your Fibonacci from C to D now, and then mark up your Fib retracement regions, which is the 50%, 61.8 and 78.6. Now you want to be patient and observe price action within this range and once you get a reaction or candlestick patterns or confirmations, which is the next topic we are going to be treating in this region or in this box, then you can now measure your stop loss and then take the trade for a valid setup, right? So let's see how this one also plays out. You have the market rejecting specifically on the 50% and the 61.8 region, and then what happens there? A continuous massive push on the opposite direction, right? Smashing through, you know, that low level, creating new lows, and then so on and so forth, right? So I believe this one gives you a good understanding of a bearish scenario when it comes to Fibonacci. Let's look at a very bullish, let's look at a bullish scenario as well, and then we'll end our lesson on Fibonacci, right? So in looking at a bullish scenario, we're going to use AUD card, which was one of the examples we use when we're talking about trend lines, right? So again, somebody may be confused because you're looking at this point as KOJO, this one making a swing point from here to here. It comes all the way down, makes a double top within this range before that pull back in the opposite direction. As far as this market still maintains this area as point A and B, so here being the A and then here being the B, if you are putting on your Fibonacci, you should start from the point A and end on point B. Right now, the purpose is you are targeting the market to come into your favorite regions, which is the 50, 61.8 and 78.6 retracement regions, right? In order not to waste time cutting on this, we can clearly see that what this market specifically comes directly in between the 61.8 and then the 78.6 retracement regions, right? And then in that area, what do you want to do? You want to watch price action between this range and see if we're going to have a continuation on the upside, right? Now you want to observe price action before you take entry, and price action here means your candlestick confirmations. Let's see what happens with this quickly. So now a massive push in our direction that we favor, right? Now once we observe a pullback at least 25% in the opposite direction, what do? We want to mark up our new swing point, right? So you delete this one quickly and then clear up every chart lines that you have on it so that you have a very clean chart to have a good perspective on the market. So we want to readjust our Fibonacci now and then plot it from this swing point here and then end it here, because now we are looking at a bullish swing point. So remember that in a bullish swing point, we start from the bottom and end at the very top. So once we end at the very top like this, we want to mark out our key Fibonacci areas, which is the 50, 61.8 and 78.6 region. Now let's see exactly what happens with this market. Drips down into the 78.6 and then spikes up, and upon spiking up, we can coincidentally see that the market just hit exactly on the fib extension of negative 61.8 before starting to push on the opposite direction. So yeah, you've seen how Fibonacci have been powerful for a setup here, and then Fibonacci has also been powerful for a setup here, even though this setup here was in confluence with Fibonacci and then the third touch of the trend line. So yes, we are now gradually getting into putting everything together, where everything which we have learned from the beginning of this lesson is going to make so much sense to you. So we've tackled them individually. We've talked about market structure, we've talked about support and resistance, we've talked about trend line. Now we've delved into Fibonacci, and now you can see how trend line third touch rule comes in confluence with Fibonacci, as I've denoted for you. And in trading, the more your confluence, the higher the probability of the setup. So at the end of this whole course, you're going to understand that we want to find as much confluence as possible before we risk money on the market, and that increases our edge in being right far more than wrong, and then that is what is going to guarantee our success in the market. So this is a very lengthy video dissecting deeply into the whole concept of Fibonacci. I hope you guys understood everything that I explained. If you didn't understand it, rewatch this video over and over and over, and I'm sure it's going to make so much sense to you, and you find so much gem in this few minutes of well spent time explaining and dissecting Fibonacci. Without wasting much time, we're going to end our Fibonacci lessons and video here, and I'll see you guys in the candlestick confirmation course shortly.